Hi everyone, welcome back to Tax Tutoring and Training. My name's Hannah, and today's lesson is on income via wages, interest, etc. So we're going to talk about what that etc. is later, but for the main purpose of this lesson is to teach you how to report wages and interest as a source of income on your tax return. As always, guided notes are down in the description below, and feel free to follow along, fill in the blanks, stay engaged, and fill out the activities afterwards so you can check your knowledge to see if you've been paying attention. With that, let's get started. So, the purpose of this lesson is to distinguish between non-taxable and taxable income, earned income and unearned income, and report these types of incomes correctly on Form 1040, which is what you as a VITA intern are going to be filling out for the taxpayer. So, let's get to it. Income is designated as all money received in the form of goods, property, and services which are not exempt from tax. And this is what we call gross income. Basically, we add up all your income that could be taxed. And this also includes income from sources outside the US. As a VITA volunteer, I'm training you to certify in the basic and advanced certifications, meaning that if a client has income from sources outside the US, so foreign income, the return is not able to be prepared by us. But if you're interested in certifying for international tax returns, you can do so at the IRS website in the Link and Learn link that I've published on my channel. So go search for that if you're really interested in becoming an internationally certified VITA volunteer. But otherwise, income from sources outside the US, out of scope for our purposes. So, in order to determine what goes into gross income, we need to understand what is taxable income and what's non-taxable income. And the determining factor for this is to determine whether the income provides an economic benefit to the recipient's financial standing, meaning it raises their net worth. For example, non-taxable income would be injury compensation, child support, insurance. This doesn't go directly to benefiting the taxpayer. It usually goes to expenses that they have to pay, things to balance it out, not specifically to raise their income level. Once we branch further into what is taxable income, we get earned and unearned income. So earned and unearned income are taxable incomes that are two separate categories. So earned income is income from the work you performed. This includes income such as wages, tips. If you're self-employed, that will include your business income. And unearned income is passive income. So things that you're not actively trading goods or services for to get money. This includes interests from investment, capital gains, dividends, that sort of thing, where you're not directly working to get your money. It's working for itself to make money on its own. So here we've sorted other types of income into taxable and non-taxable sections. So non-taxable income would be things such as gifts or inheritance, whereas taxable income would be things like gambling winnings, bonuses, estate income, jury duty fees, etc. So, as a VITA volunteer, you're responsible for interviewing the taxpayer to determine what types of income they have. This means identifying what wages, salaries, and tips they have, any interest they might have earned, any dividends from that interest, any dividends paid from stock, that sort of thing. And you're going to be doing this on the intake and interview sheet that we've talked about. And this is basically a sheet where you're interviewing the taxpayer, you're asking them questions to determine what sort of things are going to be going on their return. And most of the time when you're interviewing taxpayers, they're going to come in with some documents already. And a few of these documents include their salaries, their wages, that sort of thing. So you can file the income section of the tax return and establish basically what the base tax they're going to be owing is. Now, this could change with adjustments or credits, but for right now, we're identifying how much money they earned so we can see how much money they're going to be paying. So, Form W-2 is one of the forms that they will be bringing with them, and it's issued to employees by usually January 1st to report wages and other compensation. Most clients will be bringing in a W-2 because it's issued to them by their employer. Employers who withhold federal income taxes must issue a W-2 to their employees. So most likely they will have that, and you would report this in their 1040, which is what you as a VITA intern are going to be preparing to when you're working with the client. Schedule C Form 1040. This is to report income or loss by a self-employed or sole proprietor. We're going to be going into how to report income from a sole proprietorship business, so a business a taxpayer owns, in a later lesson. But for right now, all the income from that will be reported will be self-reported on Schedule C of the Form 1040, which will then go into the 1090, which will be reported on Schedule C of the 1040. Household employees earning less than $2,200 may not receive a W-2, which is why it's crucial to interview them to ask them how much they earned, because all of that money will still be taxable and you need to help them report it on their tax return. Some other forms of income that will be reported on these documents include tips income, and tips must be reported on the tax return if they're more than $20 a month. Allocated tips are when an employer allocates tips amongst its employees so that each tip is fairly distributed between all the employees that work, and those will usually be found in the W-2 of Box 8. So make sure to check those when you're filling out the tax return, because you will have to report that on the 1040 when you prepare the return. Scholarship and fellowship income. This is another type of income that will usually be found on the W-2 as income or the 1098-T form, which is a tuition statement from your college. And the scholarships and fellowships are normally tax-free only if it's for qualified educational expenses. Scholarships and fellowships are for education, as we all know. I'm not going to college and using a scholarship to pay for my Disneyland trip. But if it is used for something that's not educational, then it will be taxed, and you need to report that on the tax return. Interest income. So another type of income that we're going to be going over with that you must help the clients report on their tax return is interest income. And this is earned money from common sources of income such as savings accounts, CDs, savings certificates, government bonds, interest on insurance proceeds, or loan interest. And these will usually be found on Form 1099 interest. So your bank or whoever distributed the savings accounts, the CDs, government bonds, etc., they will usually give the taxpayer Form 1099 interest, and that's where you'll take that amount and transfer it into the tax software so that you can calculate how much tax they must pay on it. Now keep in mind, some bonds are federal, and that means they usually have tax-free interest. And this usually applies to state and political subdivisions, Washington, D.C., U.S. territories, etc. So those don't have to be taxed or reported. Another type of interest income is interest that you would find on a Roth IRA account or a Roth individual retirement account. And this account is tax exempt. So what this is you would put money in as you work, and then at a certain age you can take it out when you retire. And you will not have to pay tax on these distributions. We'll go over this more in depth in the next lesson, so stay tuned. But this is different from a regular IRA, which is tax deferred, meaning you pay money into it, but you will pay money when you receive the distributions when you retire. So kind of the same concept, except it will be taxed, and you will have to record it on your tax return when you get those distributions. So where are we filing the interest? So as a VITA volunteer, you're going to be reporting this on Schedule B of Form 1040. So remember, we kind of mentioned that schedules are like additional worksheets that organize additional information that the taxpayer has. So Schedule B is all about interest. So you report any interest that the taxpayer might have received on Schedule B. If you did not receive 1099 interest and you had over $1,500 of taxable interest, you will still have to record it on your tax return. Okay. Dividends. So dividends are another type of income, which is basically where a stock or company that you have stock in will pay you money just for having that stock when they do well. And there are a few types of dividends that I'm about to go over right now. So ordinary dividends are basically dividends that, ordinary dividends are corporate distributions paid out of the earnings and profits of a corporation. So this is your normal dividends, where the company you have stock in makes money, makes profit, and they pay stockholders a share of that money. And they're usually reported on Form 1099 dividends. They'll be issued by the stock you own. Now, another type of dividends are Section 199A dividends. And these are dividends which are eligible for qualified business income deduction. And deductions are basically things that you can qualify for that'll lower your gross income, so you're taxed at a lesser rate. The final form of dividends that we're going to be going over is qualified dividends. And qualified dividends are ordinary dividends that qualify for a lower long-term capital gains tax rates. And we're going to be going more over capital gains in a later lesson. But what you need to know about capital gains distributions are that they come from mutual funds and real estate investments, and we'll talk more about them later. But qualified dividends will be taxed at their rate, which is lower and more long-term. So, okay. So dividends, as we talked about, we are reporting dividends on Form 1040 in lines 3A and 3B under the income section. And the software we're using is TaxSlayer, so they'll walk you through it. They'll have a section where you report ordinary and qualified dividends, and that's where you would record if the person had any. Patronage dividends are distributions of profits paid by cooperatives to owners, dividends paid on property bought for personal use, and they are not taxable. And like we mentioned before a little bit, capital gains distributions are also recorded on Form 1040, and these are from mutual fund and real estate investments trusts, and these are taxed at a lower long-term capital gains rate. These will have the same tax rate as the qualified dividends that we talked about before. Now, this slide is some concepts that are out of scope for the VITA intern program. So, for example, if the dividend boxes are labeled as unrecaptured, or there's a qualified small business stock, or there's repayment of shareholders' investments, which is not income. So we won't be going over this. Just know that you don't need to do this as a VITA intern. All right. So Form 1099-G represents state and local tax refunds. So sometimes you'll be in a state that has state tax, and you'll have to fill out a separate return for state tax, or they'll make you pay state tax, right? And so I live in Nevada. We don't have to pay state tax, so VITA volunteers in our state don't really have to worry about this, but most states will have state income tax, and taxpayers who have been issued Form 1099-G have had refunds from that state income tax, meaning that a taxpayer itemized deductions last year and they received an income tax benefit. Meaning they paid withheld taxes to the state and then got a refund last year and was able to get money from their state in a tax refund. They will have Form 1099-G. You should not report this on the federal income tax return if state sales tax was already deducted. Right. The last type of income that we're going to be going over in this lesson is alimony. And alimony is payment to one spouse under a separation agreement. So this is not child support or voluntary payments. It's two people had a divorce, and one person, and part of the divorce decree was one person has to pay some money to the other spouse for caring for the child. Now, this is different because there was a rule change in 2019. So if the divorce was between 1984 and 2019, the person receiving alimony must include as income. The person receiving the alimony check must include the check as income. So the spouse receiving the payment must include the payment as income, and the person who paid the check could subtract the amount paid, the alimony paid, as an adjustment to income. And we'll go over adjustments later, but that's basically reducing your gross income so that you have to pay less taxes. If the divorce was after 2019, which is when the rule change was made, alimony and separate maintenance payments are not deductible by the payer. So this means if my spouse, I had to pay alimony to my spouse, I would not be able to deduct the income as an adjustment. Some more concepts that are out of scope for VITA volunteers are farm income accrual. If the taxpayer owned a small business and they use the accrual method for reporting income, if tax refunds were received from other than last year. So remember how we talked about state tax refunds? If they were received not last year, but like say 3 years prior, that's out of scope too. And alimony before the year 1985, because as we mentioned, only from 1984 to present that we can do alimony payments. So if you come into contact with clients that have any of these out of scope issues, please refer them kindly to a professional taxpayer who will be able to help with their more complicated needs. So as always, please let me know if you have any questions. I know this lesson is very confusing for pretty much everyone who learns it, but I hope I clarified some of it, and I hope you do well learning the next lesson. So stay tuned for retirement income, which will be up next. Thank you guys for watching, and have a great day.